Hello and welcome to Chapter 11, and in this chapter we're going to discuss two different types of corporations. The first one is called the Subchapter C Corporation, and the second one is called the Subchapter S Corporation. All companies, when they form a corporation, are automatically considered to be Subchapter C corporations. All the major corporations in America are Subchapter C corporations. Now, what's the difference? A Subchapter C corporation is a legal entity unto itself, and it pays its own taxes. A Subchapter C corporation is also a legal entity unto itself, but the income from the S corporation passes through to the individuals much like a partnership does to its partners. Okay, that kind of gets the basics out of the way there. Okay, in 2017 and before, the top corporate tax rate is generally considered to be 35%. Now that's going to change in 2018, where the corporate rate will now be defined as 21%. Okay, now that doesn't mean that's the same rate for every dollar. Just like individuals, okay, corporations pay taxes at different rates depending upon their taxable income. So let's take a look at page 11.2 in your book, and we'll get a chance to look at the corporate tax rates. Okay. Throughout this book, and generally in any accounting textbook, it'll tell you that the corporate tax rate is 35%. The reason for that is, if we look at table 11.1, you notice that it says if the taxable income is over $18,333,000, that the tax rate is a flat 35%. Okay, and then since most major corporations have taxable income over that amount, that's why they usually say the corporate tax rate is 35%. But it isn't for all corporations. So much like the individual tax tables, you can see the corporate tax rates as shown in table 11.1. Okay, now there's a bubble built in because if you notice, the rate goes from 15 to 25 to 34 to 39, and then back down to 34%. Then up to 35, up to 38, and back down to 35%. I'm not going to try to really explain this. That it is what it is, and if your income falls within that taxable income over a certain amount but under a certain amount, you're going to pay what it says in the column where it says the tax is. So if you get a tax problem, all right, that's what you're going to be using this table 11.1 to calculate your taxes. Okay, so when a corporation has income, okay, so let's go ahead and take a look at the tax return for a second. All right, so I'm going to kind of move ahead a little bit here to page 11.9 in your book. Okay, and this is the first page of Form 1120. Form 1120 is what is used for a Subchapter C corporation. So this would be the return that would be filed by all the major corporations in America. Okay, it kind of looks like the partnership return. All right, you have the income up there at the top, okay, and then you have the expenses or the deductions down below, all right, and arriving at taxable income, all right, on line 30. Okay, not that hard to calculate for most returns that we would do in this class. All right, there is some differences though between corporations and individuals. All right, corporations cannot deduct capital losses. Individuals can. All right, this is discussed on page 11.3. All right, for the most part, corporate capital gains are pretty much going to be taxed at the max rate of 35%. All right, it tells you that Congress designed the idea that corporations would make really no difference between their ordinary business income and their capital gains. All right, that's why the tax rates are very close to each other, and because capital losses are not allowed. Okay, now if you remember, individuals can deduct capital losses up to $3,000 per year in excess of their capital gains. That is not true for corporations. All right, corporations can only deduct capital losses up into the amount of their capital gains. All right, any excess losses can be carried back 3 years, okay, to offset any taxable income that they had in prior years. Okay, all right, and forward 5 years. All right, forward 5 years. All right, so keep that in mind in case, like I said, just in case we have something on the last test like that, or if you have to fill out a homework problem that involves capital losses. Okay, remember they're not allowed. Okay, all right, so we're going to move on a little bit to page 11.4. All right, we have a couple deductions that I want to talk about. We have a dividends received deduction on page 11.4, and we have some organizational expenses on 11.5. Okay, all right, the dividends received deduction is a little bit unusual, all right, in the fact that you don't see that, of course, for an individual or a partnership. All right, what this is, if we go back to page 11.9, okay, go to page 11.9 and look at line 4. Okay, look at line 4. All right, it says dividends, Schedule C, line 19. Okay, turn the page. Go to page 11.10 in your book. All right, and you'll notice that the column little letter A is the total of the dividends received. Now, what do they mean by that? Well, companies make investments all the time. All right, primarily in stock of other companies. All right, they just don't let their money sit in a bank account. All right, and if they invest in stocks, all right, of course they, some of those stocks will pay dividends. And so when a company declares a dividend, all right, and reduces retained earnings, all right, that dividend is paid to the investor, all right, usually in the form of cash, all right, and then the investor will record those dividends on Schedule C of Form 1120. Okay, so if we go back to page 11.9, okay, and we look back on line 4, that's what they're talking about, is the dividends received on stock held in another company. Okay, well, as it mentions at the top of page 11.4, okay, technically stock, the stock dividends or dividends on stocks could be taxed 3 different times. Okay, so let's see what it says in that second paragraph on page 11.4. Okay, all right. If it says when a corporation owns stock in another corporation, income earned by the first corporation could be taxed 3 times. The income is taxed when the corporation that's paying the dividend first earns it. Okay, then it's going to be taxed again when the investor receives that money and has to report it on line 4 of page 1 of the 1120. Remember that when the corporation that pays the dividend, if you've taken Accounting 101, you remember that basically the journal entry is to debit retained earnings and credit cash. So the corporation doesn't get an expense for paying out a dividend. So they're paying taxes on that net income that that was used to pay the dividend. So that's once. The receiving corporation, okay, line 4, 1120, that's twice. Okay, and then when you mix all that money up with the other taxable income that the company has, then the investor pays out dividends to the companies or individuals that invested in it. and then that entity will pay taxes again. So this could be taxed 3 different times. So how did they get around that? Okay, well, what they do is if you go back and you look at page 1110 again, okay, all right, it'll give you, all right, different types of dividends. So on line 1 of Schedule C, it says dividends from less than 20% owned companies. That means that the investor or whoever is filling out this tax return owns less than 20% of the other company, okay, that it invested in. All right, if it owns more than 20%, okay, then it'll put the amount on line 2. Okay, so what does that mean? Well, we're going to go back and take a look at page 11.4, and here's the percent of ownerships. All right, it says less than 20%, you get a dividend received deduction of 70%. So if you invest, you know, and you get, let's say, $10,000 in dividends from another company, if you own less than 20% of that company, you automatically get to deduct 70% of those dividends. If you own between 20 and less than 80% of that other company, you get to deduct 80%. And if you own more than 80% of that company, it is as if you own that other company. And so therefore it's like, you know, robbing Peter to pay Paul, so to speak. And you would get to deduct 100%. Okay, so where do I get to deduct that? Well, if we go back and we look at page 11.9, all right, you'll see that if you look at line 29B, it says special deduction Schedule C, line 20, and that the dividend received deduction will be on Schedule C. All right, so it gives you a couple examples on page 11.4. All right, this will be on your next test. All right, guaranteed. So make sure if you're listening to this video that you study any of the problems that I gave you. You know, at the end of the chapter, I gave you all the solutions. All right, so study the problems at the end of the chapter that involve the dividends received deduction. Okay, this would be a very common deduction on a tax return. All right, so we're going to test it. Okay, all right, so make sure you look at that. So let's just take a look at the 2 examples real quick. All right, at the bottom of page 11.4, you got Hackberry had the following income and expenses. So they had gross income from operations of $240,000. They had expenses from operations of $200,000. Okay, so not including the dividends they received, they actually made $40,000. Then they add the dividends of $100,000 that they made, so their total income was $140,000. So their deduction is limited to either $80,000, the amount of the dividends, or 80% of the $100,000 in dividends they received, or $80,000, or 80% of the $140,000. All right, again, 240 minus 200 is 40, plus 100 is 140. Take 140,000 times 80%, that gives you 112. All right, take the lesser of 80,000 or 112, and that's the amount. If we go back and look here, let's go to page 11.9. All right, in other words, in that first example, they would put $80,000 on line 29B. Line 29B. All right, look at the second example. In the second example, the income from operations, all right, was reduced by $50,000. Okay, so now they have a net loss from operations of 10. Okay, they still made an extra $100,000 in dividends, so their total income is 90. All right, so what they do is they'll take 80% of the 100,000 or 80,000, or 80% of the $90,000 net income, which is $72,000, and take the lesser of the 2. So they would put $72,000, not $80,000, on line 29B of Form 1120. That's it for this video.